Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cathay Pacific Airways Limited annual report. Cathay Pacific Airways Limited offers a wide range of services to cater to the diverse needs of its customers. At the core of its operations are airline transportation services, which include passenger and air cargo transportation. The company provides various support services such as catering, cargo terminal operations, ground handling services, and commercial laundry operations. In addition to these services, Cathay Pacific operates scheduled flights across multiple regions worldwide. Its extensive network spans the Americas, Europe, Southeast Asia and Oceania, North Asia, South Asia, the Middle East, and Africa. This global reach enables the company to connect people and businesses across different parts of the world. The airline's fleet consists of 234 aircraft, with a significant number of new passenger and freighter aircraft added to its inventory as of June 30, 2025. This modern and diverse fleet allows Cathay Pacific to offer efficient and reliable transportation services to its customers. With over 7 decades of experience in the aviation industry, Cathay Pacific Airways Limited has established itself as a leading player in international air travel and logistics. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for Cathay Pacific are multifaceted. One key factor is the increase in passenger flights and frequencies, which has led to a rise in belly space for cargo. This, combined with an increase in load factors in Cathay Cargo, has contributed significantly to revenue growth. Strong demand for general cargo to Hong Kong, particularly from Nepal, Sri Lanka, and South Africa, has also been a major driver. In addition, the introduction of innovative solutions such as Cathay Fresh and Cathay Live Animal has expanded the company's offerings and attracted new customers. The export momentum from the Chinese mainland, including high-tech electronics, has also contributed to revenue growth. Furthermore, the increase in Cathay membership base by 27% has led to a rise in usage of Asia Miles for full or partial payment. The growth in flight awards, surpassing pre-pandemic and 2024 levels, has also been a significant driver of revenue growth. The Cathay Members Rewards in the Air campaign has boosted brand awareness and engagement, while partnerships with fintech companies have expanded the company's offerings. The expansion of the Expedia-powered Cathay Holidays platform has also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are largely due to external factors. Weaker revenue efficiency in long-term forecasts due to increased competition is a major concern for Cathay Pacific. Decrease in South Asia, Middle East, and Africa by 25.4% has also led to a decline in revenue. Furthermore, revenue decline in cargo services by 7.6% from 2023-2024 has been a significant contributor to the decline. Net income of the company saw a significant increase of 9.5% from H$9,888 million to H$10,828 million in 2025. However, this growth was not uniform across all subsidiaries. HK Express reported a substantial loss of H$996 million in 2025, compared to a loss of H$104 million in the previous year. In contrast, Air Hong Kong recorded a profit of H$954 million in 2025, which is comparable to its profit of H$957 million in 2024. Despite the overall increase in net income, the company's profit margins experienced a slight decline of 0.2 percentage points to 9.3%. This decrease may be attributed to various factors, including increased competition and rising operational costs. However, it is worth noting that HK Express expects sustained profitability due to its low-cost carrier business model. The company's financial performance is a notable aspect of its overall health. A review of the data reveals that the company has been generating positive operating cash flow in recent years. Specifically, the operating cash flow for 2025 and 2024 was HK$24,118 million and HK$21,319 million respectively. This trend indicates a consistent ability to generate sufficient cash from its core operations to meet its financial obligations. The fact that the company has been able to maintain positive operating cash flow over this period suggests a strong underlying business model. The company's debt level has undergone a significant reduction over the past year. The net borrowings have decreased by 19.2% from HK $57,941 million to HK $46,812 million. Additionally, borrowings have also seen a decrease of 13.7% to HK $59,101 million. Furthermore, total borrowings have dropped from HK $68.475 million to HK $59.101 million. However, despite the reduction in debt levels, the company's interest expenses have increased. The interest expense has risen by HK $69 million from HK $124 million in 2024 to HK $193 million in 2025. Moreover, the net change in interest expenses has also seen a significant increase of HK $585 million. This suggests that while the company may be reducing its debt levels, it is still paying more in interest expenses, indicating a potential shift in its financial strategy. The performance of various segments and regions in the aviation industry has been mixed, with some areas excelling while others struggled. The Asia-Pacific region stood out as a top performer, driven by strong growth in countries such as Hong Kong. Within this region, airlines like Cathay Pacific's Air Company and Hong Kong Express demonstrated impressive financials, with revenue exceeding HK $14,458 and HK $13,791 respectively. However, other regions fared poorly. Europe lagged behind the Asia-Pacific region in terms of performance, while the Middle East was impacted by geopolitical tensions and military actions in Ukraine. The Ukraine region itself suffered significantly due to ongoing conflict. Additionally, passenger travel was affected by a range of factors including tariffs, sector-specific import/export controls, immigration rule changes, and shifting demand for air cargo. The Hong Kong International Airport, HKIA, faced substantial operational and logistical challenges, while the global economy remained exposed to risks from macroeconomic conditions, trade wars, and geopolitical tensions. The aviation supply chain continued to recover from the effects of COVID, but was further complicated by escalating trade tensions in 2025. As a result, airlines like Cathay Pacific's premium service faced pressure on yields due to competition from low-cost carriers. In terms of specific financial performance, the Hong Kong segment reported a loss of $996, while the associate segment incurred a loss of HK $709. These results highlight the challenges faced by certain segments and regions within the aviation industry. Management is optimistic about the company's outlook, citing 3 consecutive years of solid financial performance. They aim to sustainably grow the business for customers, people, shareholders, and Hong Kong, with a focus on digital innovation and operational excellence. The company plans to invest over $100 billion in fleet, cabin, and lounge products, as well as digital capabilities. Cathay Pacific's goal is to become a digital leader, renowned for its strong digital culture and capabilities. They aim to deliver operational excellence through efficiency and reliability, built on a fully integrated approach to planning and delivery. The company also prioritizes sustainability, with targets including reducing single-use plastic items per passenger to 1.5 by mid-2026. Management is confident in the company's long-term prospects, expecting revenue growth to continue with a 12% increase in operating gain/loss before non-recurring items. They believe that shareholder value will be maximized in the long term and aim to deliver satisfactory and sustainable returns to shareholders. The company's purpose, values, and strategic directions are aligned with its culture, ensuring a strong foundation for future growth. The acquisitions and divestitures of Cathay Pacific Airways can be summarized as follows. Cathay Pacific has made several significant acquisitions in recent times. One notable acquisition is the purchase rights for an additional 14 Boeing 777-9 aircraft, which will enhance the airline's fleet capacity and efficiency. Additionally, the company has acquired a shareholding in Qatar Airways Cathay Pacific, further expanding its global reach. In terms of divestitures, Cathay Pacific has disposed of certain assets to optimize its financial performance. The airline has sold preference shares, warrants, and convertible bonds, which will help reduce its debt burden and improve liquidity. Furthermore, the company has also written off losses incurred by its subsidiary, HK Express, allowing it to focus on more profitable ventures. Overall, these acquisitions and divestitures demonstrate Cathay Pacific's strategic efforts to strengthen its position in the aviation industry while optimizing its financial performance. The company has demonstrated its commitment to returning value to shareholders through various means. In terms of dividend payments, it is clear that the company has paid dividends in 2025 and has proposed a significant amount for the year. Specifically, $5,228 million was distributed as dividends to ordinary shareholders in 2025. In addition to dividend payments, the company has also engaged in share buybacks. This includes repurchasing preference shares, warrants, convertible bonds, and even Qatar Airways shareholding in Cathay. The total principal amount of $558 million was settled and cancelled under the bonds repurchase program. These actions demonstrate a proactive approach to managing shareholder value and returning profits to investors. The aviation industry is facing significant challenges related to supply chain disruption and inventory buildup. Ongoing supply chain disruptions, as mentioned on page 7, are causing delays in the delivery of new aircraft, cabin products, and parts. This issue is further exacerbated by Pratt & Whitney engine problems, which have resulted in some HK Express aircraft being grounded, page 9. The industry-wide supply chain risks, including geopolitics-driven tariffs and sector-specific import/export controls, are also affecting supply chain stability, pages 76-78. These concerns are not only impacting the delivery of essential components, but also resulting in increased costs for airlines. For instance, lease payments for storage of engines and inventories have risen significantly, page 123, while inventory technical management services paid to HAECO Group have also seen an increase, page 49. The aviation sector is experiencing supply chain challenges in the form of shortages and geopolitically driven sanctions and tariffs on suppliers. So that concludes the financial summary for Cathay Pacific Airways Limited. Feel free to comment below, and I will be happy to answer them when possible.